Glad to be here. Thank you very much.
Well, today, turning to the market story that has dominated the news this week, Geoff, how bad is the WorldCom fallout and who's been hurt?
Karen, it's a lot worse and has hurt a lot more people than you might think. The fact is, any one of us might have owned WorldCom stock without knowing it. Many mutual funds and pension funds held the stock, including some of those popular Vanguard and Oppenheimer funds, as of the end of last quarter. The losses have been mammoth. Not surprising, since the company was once worth $160 billion and is now worth little, if anything. The stock hasn't traded in days. The retired teachers and state troopers of the New York State Common Retirement Fund have lost $300 million. CalPERS, the California Public Employees Retirement System, has lost $565 million on WorldCom stock and bonds. And the New York City Pension Fund, which supports the families of New York firefighters and police officers, among others, has lost $100 million on WorldCom, Karen.
So the question is, how do you spot the next WorldCom? President of Chanos Associates has been hailed as a David that slew Goliath, a straight-up guy loaded with integrity. He was the first to blow the whistle on Enron. A short seller, he manages over $1 billion. His Ursus, or Bear Fund, has seen some nice gains, up over 18% in 2001, and at the end of May, up 4.5%. And Jim Barrow loves the ugly stocks, finding value in companies everyone else hates. As a manager of Vanguard's $23 billion large-cap Windsor II fund, he has well outpaced the S&P over the past decade. His mid-cap fund, Vanguard Select Value, returned 15% in 2001, and so far this year, up 4%. Thank you, gentlemen, both, for joining us. Let me ask you first, Jim Chanos. Now, translating Greek from Latin, your company's name means kind of cynic or cynical, bear. How do you play this? Do you think all investors now have to be cynical to continue, and will that continue to define this market?
Karen, I don't think all investors have to be cynical, but I do think that investors need to take care when they invest. They need to investigate on their own. I think in light of the accounting scandals that we're seeing this year and last year, it behooves investors to pay more attention to what they're doing, what their managers are doing, and to make sure that their money is being invested prudently and within the guidelines that they accept for risk.
Jim Barrow, in this environment of erosion of confidence, how can you even step up to the plate and buy anything?
We focus on companies that have low price earnings ratios, that have low price to books and have high current yields, and we try to get a fair amount of diversification in our portfolios. And I think if you focus on a portfolio with a 15 PE and a 2.5 or 3% kind of current yield, I think you're going to be all right in these rocky times. And when things get better, I think we'll do just fine.
When do you think they're going to get better?
Well, the market itself is not cheap. Looking at the S&P or something, but there's still a representative group of companies that are cheap enough to buy, cheap enough to own, and have good fundamentals, and we don't have any problem with finding names.
Well, Jim Chanos, you mentioned that investors should check with their management, but in this area of accounting fraud and scandals, I mean, how can they believe anything that they see or read or hear?
Well, that's the $64,000 question currently. I think former Secretary Rubin hit it on the head. We do need to look at the accounting profession, the accounting issues, and I think something has to be done, particularly in light of some of the large-scale frauds we're seeing. I'm not so sure I know what needs to be done, even as a user of financial statements. It's amazing, but I can't think of one major financial fraud involving a large publicly held company that has been unearthed by the outside auditors in the last 10 years. It really has been the press or an inside whistleblower or God forbid, even short sellers.
People like you, Jim, right? You found many of them over the years.
It is amazing that more of them haven't been found by the outside auditors, and I think that alone tells us there's need for reform.
What don't you like now?
Well, generally there's a few areas we don't like, broadly speaking. Although the stocks are down quite a bit, we are still quite negative on the cable TV area. Cable TV, as you may know, is an area that's been valued on a so-called EBITDA basis. And I think this past Wednesday we saw the death of EBITDA with the WorldCom disaster. But what bothers us most about the cable industry is this is an industry that's never had free cash flow, never had earnings, and has very high ongoing capital expenditures. So the depreciation and amortization, the DA and EBITDA is real.
Just for anybody who isn't clear on it, EBITDA is earnings before interest, taxes, depreciation, and amortization.
Right.
In other words, earnings before a whole lot of things that make earnings smaller.
Exactly.
And free cash flow is cash flow after all the capital expenditures. And in the cable business, you've got a lot of capital expenditures.
And always have had, and probably
always will. Exactly.
Jim, you're talking about looking for value. Things are very overvalued if you're looking at price-earnings ratios now. What are you buying? What do you see? What are your major picks?
Well, we have big holdings in tobacco companies. They've had a bad week this past week, but that 1 week does not a year make. We have big holdings in oil companies. We have large holdings in utilities.
How can you justify that?
Oh, the energy I'm talking about are large oil companies, not, I didn't own Enron or that sort of thing.
You're talking the Exxon Mobils, that sort of thing?
That sort of thing, yes.
But are they still considered cheap?
I think so, yeah.
In other words, Jim, these are big holdings of yours, but you'd still buy them today?
Yes.
Okay, good to know. And similarly, Jim Chanos, the things that you are short, you'd still go short today?
I'd still go short today.
On cables, what else?
Well, after that, it's fairly eclectic, Jeff. We're looking at individual companies. We try to make a stand on the market as a whole.
Right.
So it's a variety of sort of individual situations that we think have either problems with their business plans or problems with their accounting. Well, one thing I think is still worth examining is the extent to which companies are using stock options as compensation and not expensing it in their income statement. For example, a company we're short is Yahoo, well-known internet search engine company. And last year, in 2001, their stock option expense, which is buried in a footnote, exceeded their revenues.
Not just profits.
No,
But
revenues.
exceeded their revenues.
Exceeded their revenues.
An enormous amount. You know, that reminds me, it was a little over 2 years ago that the NASDAQ was at 5,000. I want to ask each of you, how long will it take before it's back at 5,000?
Well, when it was 5,000, a lot of people asked me, you know, where it could go, and I thought 1,000 was the right number. And we're getting pretty close there, too. You have to remember that it went up there in such a rapid, it went from, in 1998, NASDAQ was at 1,300, about. It doubled in the next 12 months to 2,600. And in the next 8 or so months, it went from 2,600 to 5,000 and something. And yet, the higher it got, the less earnings there were. If you took out 5 companies, there were no earnings in NASDAQ.
Jim Chanos, when do you think the NASDAQ might get back to 5,000?
Well, Karen, I started my short-selling fund when the Dow was at 1,300, so I'm not exactly the right person to ask, all right? Having said that, I'm generally an optimist on the U.S. economy, as former Secretary Rubin is, so I don't know. I think that over time it'll ultimately get back there. I know that's an easy answer, but my guess is we'll be there as soon as we get through this.
It'll have to have a different makeup, though. The companies, some of the companies that were very high at 5,000 are never going to get back there. So
it'll be a different NASDAQ. It'll be a different NASDAQ that makes it.
Well, NASDAQ is really just a group of companies that happen to trade there.
On that exchange, I understand. Okay, thank you, Jim Chanos. Thank you, Jim Barrow. Karen, these guys seem to think it'll take a long time before the NASDAQ is anywhere near 5,000 again. What do other investment pros think?
Well, Jeff, top money managers surveyed by Money Magazine don't think it will crack that level for at least another decade. 48% of the respondents believe it could take 11 to 20 years for the NASDAQ to climb that high again. And 11% don't think it will happen in our lifetime. So are the rich as pessimistic as the rest of the market watchers? Another survey shows that 76% of people worth over $1 million don't believe what they read in corporate financial statements. And how about all those great stock picks that come from your broker? 73% don't trust stock recommendations from equity analysts. The biggest worry facing the wealthy? Terrorism and its impact on the economy and securities markets.
Well, Karen, Martha Stewart has much more immediate worries. She was the other inescapable stock market story this week. But some people might have forgotten just how completely her situation has reversed. Only a few months ago, when Kmart was heading for bankruptcy, Martha said, of course, she'd be loyal to her longtime business partner. Now, this past week, a reporter asked Kmart if they'd stick with Martha. And without a trace of irony, they said, yes, they sure would.
Well, let's take a look at what will affect the short holiday week on Wall Street. We'll find out next Friday just how many people have been handed pink slips. The nation's unemployment rate for June is expected to rise slightly.
We've planned a very special show for you on the next Wall Street Week with Fortune. We're going to help you figure out who to trust.
Our colleagues at Fortune magazine have been crunching the numbers, and they've come up with Wall Street's all-star analysts. You'll hear from the ones that have gotten it right.
We'd like to hear from you. Your comments, your questions, your criticisms, send them our way to Wall Street Week with Fortune here in Owings Mills, Maryland, 21117. You can also email us at wsw@pbs.org, and be sure to visit us online for a weekend web edition of Wall Street Week with Fortune.
That's it for tonight. We'll see you next week. Good night.
So long. See you soon.
To learn more about this.
Thank you for watching, and remember to like, comment, and subscribe.